Hey everyone, hey everyone. Welcome to the Money Level Show. If this is your first time here, this is where we think, act, and prosper. We don't just absorb information just to stand by and stare at it like, you know, we got to apply what we are learning. So that's why we think, act, and we prosper as a result of thinking and acting. So today we got a few things to jump into. I hope you all are doing well. Um, yeah, it's kind of hot, in my little studio today. I'm in Washington State, where we don't have as many AC units or whatnot, so it can get kind of toasty in the summertime. But I'm alive, you know what I'm saying? So I have nothing to complain about, really. I'm also watching my kiddos over here on the screen, making sure they don't wake up. So if I got to dip out of here, to handle some father duties, I'm gonna be a father first. You know what I mean? So that's what it's about. So today we're going to talk about why stocks were getting plummeted, as well as if silver is set to beat gold. There's an article on Zero Hedge that outlines the reason why silver is going to outperform gold. And so I do want to look at that. So I see that we got some viewers out here. So please drop your name in the comments, drop a comment or whatnot, so that I can acknowledge you and appreciate you for coming on. So be sure to do that, please. All right, so uh, today, Moody, another bank slash financial institution, gave a credit rating to the banking system and said that the banking system is pretty much unstable. Um, and so we're going to get to that, and we're going to figure out what is Moody, what makes their credit rating credible or whatnot, and what did they actually say. So that's what we're going to get into here before we get into the article about silver and gold. So let's go ahead and share my screen. Dun, dun, dun. All right, so here's Moody's better decisions. So their mission is to provide trusted insights and standards that help decision makers act with confidence. So pretty much, they're a global integrated risk assessment firm that empowers organizations to make better decisions. So they're a assessment firm, which, I mean, they assess the risk in organizations and such. So that gives them, some credibility there. And they also have investors service, and they have analytics. So it sounds like they do some assessing of the financial systems and such. And so that's Moody. All right. So we're going to look at their credit ratings. So this is what came out recently that helped, that pretty much contributed to the markets getting, I wouldn't say pummeled, but they took a right blow from Mike Tyson. Let's say that, but they didn't get knocked out. So U.S. banks funding risks, weakening profitability, and increasing asset risk will test credit strength. Rising funding costs and declining income will erode U.S. banks' profitability as loan losses begin to rise, particularly in commercial real estate. Commercial real estate has been something that has been talked about by many financial experts. That they say that that's the ticking time bomb. Is and the banks own a lot of commercial real estate, and so ever since the pandemic, many people aren't going to work. Many people aren't, they're commuting. They aren't commuting. They're working from home, or like people are in the office like 3 days a week and such. And so, like, commercial real estate has been hit pretty dramatically. And so that's what they're talking about, where the risk is. So, dang, I got to freaking sign up to read the report. We're going to pop over to Yahoo Finance to see what Yahoo had to say about the report. Let's just do that. All right. So here we go. Yahoo Finance. Boom, boom. Here we go. All right. Moody reminds investors that regional banks aren't out of the woods yet. The banking industry got another reminder Tuesday that the problems that roiled the financial world in the spring are not yet in the past. Regional banks fell Tuesday after Moody's Investors Service downgraded 10 mid-sized institutions by a single notch. So these are the banks that they downgraded. Moody's also warned about a review of 6 other banks for possible downgrades. That includes U.S. Bank. So I was invested in U.S. Bank. I got up out of there, but yeah, that's one that's on their radar. So we'll see what happens. The share price goes tumbling. I may pick up a couple shares or something. We'll see. And then the Bank of New York Mellon, I'm not sure. I think Warren Buffett may invest in them. I think we'll go look at that, Warren Buffett's holdings. But he may have this bank there. I think he has his biggest holding is Bank of America, but I think he may have this bank as well. I could be wrong. Let's see, stocks of many of these banks closed down by more than 1%. As the S&P banking ETF dropped more than 1% as well. Moody's attributed its decisions to a series of pressures making life more difficult for mid-sized financial institutions across the country. From higher deposit costs to eroding profitability to new capital requirements and a commercial real estate slump. All right, so what they're saying is that higher deposit costs. So people that put their money in these mid-size or small banks want to earn a yield on their money. They want to earn interest on their money. So that is a cost to the bank. And so the bank has to pay the depositors money on their money. So that's higher deposit costs, eroding profitability. Obviously, that sucks money out of the system. And then you also had many banks that bought bonds, like 10 to 30-year instruments that were, when interest rates were at 0% then. So now interest rates are at 5.25%. So they lost a lot of money on that. So, eroding profitability to new capital requirements and a commercial real estate slump. So, and we just talked about commercial real estate. So there's still issues within the banking system. I just interviewed Alistair McLeod. He talks about that quite a bit. So we'll see what happens if more dominoes are going to fall or not. So what do y'all think about this? Y'all think we're out of the woods or what? What are y'all thoughts? I want to know. Because for me, obviously, FDI insured, I'm not depositing over 250K, in the bank anyway, but, this is definitely a risk for bank runs and such, and even banking stocks to really take a collapse and also like the broader markets, especially if it's a severe banking system crisis that we may experience. And many people talked about this, like Danielle DiMartino Booth. She just did an interview. Like many people continue to talk about we aren't out of the woods with the banks yet. Even though the one was back in March, like we are not out of the woods. And so this Moody's credit rating definitely has some validity and weight to it. But we'll see how everything plays out. If you're here viewing with me today, please drop a comment. I'd like to know who's here with me. And also you all can join my YouTube membership. The YouTube membership, $6.99 a month, a cup of coffee a month. You get access to many perks, such as submitting questions to the guests that I bring on the interview, priority consideration for your questions. You get to get shout outs to in the videos as well. So like shout out to JT Coin Rings. He is a member of the channel. And you get other perks such as being able to view some of the interviews early and such. And then I also want to let you all know about the New Orleans Investment Conference coming up. So I'm going to play a quick 46-second ad. I know that attention spans are short, but just watch the ad, consider what I got to say. All right. Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview. All right. Obviously, I'm interviewing myself right now, but we're getting back to the interview. I'm posting that link in the chat right now. So if you would love to support the channel by signing up through my link to go to the investment conference, that would be greatly appreciated. So now let's get to the silver. All right. So there was an article on Zero Hedge that is titled "No Silver Lining for Gold Investors." So I'm gonna go ahead and share my screen. We're gonna get to that article. I love just getting different perspectives on the markets and things of that nature, even if I agree or not. I just love to get different perspectives. So this is by Derailed Capitalism. No silver lining for gold investors. Why gold has lost its glitter against silver. Owning gold had a cash it for investors is typically because the kink of precious metals had inflation-proof qualities. Many investors have built core portfolios around gold in an inflation-rampant economy. Though that strategy of wealth building is quickly unraveling, consistent interest rate hikes by central bankers around the globe give savvy investors an opportunity to rotate away from gold and into greener pastures, silver. Let's see, cold hard facts. I want to know cold hard facts. If betting on a losing horse is your thing, then sure. But you can buy gold and overweight your portfolio with the king of all precious metals. Many gold investors have taken to holding gold bullion and even gold coins as part of their portfolio construction. The reason they did so was because of the sensitivity of gold to real interest rates. Since no cash flows occur from holding gold, there's an inverse correlation with real interest rates. Okay, so they're saying that many people are overweight gold. Gold is the king of them, and gold doesn't give you a return on your money. And so they were expecting, gold to go up because of real interest rates. When interest rates are high, they were expecting that they would be able to, cash flow from gold. So that's pretty much what they're saying. My bad if I butchered that, y'all. My bad. Yeah, if you're watching, drop a comment. All right. So if safer cash generating assets such as US Treasuries offer a higher yield, as they do now in a high interest rate environment, the appeal for non-cash generating assets like gold, however, drops. In an inflationary economy like we currently have, strong economic signals give the US Fed a reason to further hike interest rates. Analysts believe that recent robust labor data has provided the central banker the justification or excuse to raise rates yet again. And that spells gloom for gold prices. As the Fed began aggressively raising interest rates in its quest to stamp out stubbornly entrenched inflation, it sent gold investors chasing treasury bonds and other safe haven assets. Gold prices either fell or remain largely static, causing significant underperformance to gold-weighted portfolios. Savvy investors who pivoted away from the gold trade fared much better. Now, they do have a good point here. All right. I mean, unless you bought gold in freaking October 2022 when it was down, you would have been better off if you would have bought US Treasuries where you earned 4 to 5% over that during that time frame, because gold has been staying steady. So they make a good point. I think they meant gold bugs here, a viable alternative for stressed out gold bugs. So if gold loses its luster in inflationary high interest rate environments, then what's in an alternative strategy to supercharge precious metal portfolios? The answer is silver. And the secret to profiting from gold's lack of shine lies in a critical metric known as the gold to silver ratio. So he's saying, I mean, silver's still 50% off its high all-time highs. Gold is near its all-time highs. So silver has a lot more room to run. The gold to silver ratio serves as a vital tool for savvy investors seeking to diversify their precious metals holdings and maximize returns. This ratio gauges the number of silver ounces required to purchase an ounce of gold at any given moment, an interplay of supply and demand for both metals, as well as various other economic factors influence fluctuations in the ratio. All right. So it says to illustrate, an 80-to-1 ratio signifies that it takes 80 ounces of silver to buy 1 ounce of gold, implying silver is relatively inexpensive compared to gold. Which, for those that don't know, historically this is a super high ratio, which we'll get to a gold to silver ratio chart. But this is a super high ratio. I think Isaac Newton set the ratio at, I think it was 13-to-1, 15-to-1, something like that. And now it's at 80-to-1. And so the gap closes, the gap closes every now and then, not like fully back to where it was, but it comes down significantly. I think the most significant runs we've had with silver would have been probably, I think it was close to 30-to-1 or something like that. My bad. Yeah, I'm trying to fill out this chart. Find this gold to silver ratio chart. It's showing up the daily, but I need to find the actual historical chart. We'll get back to that. So gold to silver ratio currently is at 80-to-1, so it's pretty high on a historic basis. So that's pretty much what they're saying. Now, so let's use information discussed earlier to demonstrate how favorable gold to silver ratio can be beneficial for a decision to buy silver. We'll compare two different ratios, 80-to-1 and 40-to-1. All right, so the 80-to-1 scenario. In this scenario, it takes 80 ounces of silver to buy 1 ounce of gold. That implies that silver is relatively cheap compared to gold. If an investor has 80 ounces of gold, decides to trade it for silver at this ratio, they would receive 6,400 ounces of silver. So by trading 80 ounces of gold for silver, the investor will end up with 6,400 ounces. Let's see if the gold ratio is gold to silver ratio is 40-to-1. It takes 40 ounces of silver to buy 1 ounce of gold. Now gold is relatively more expensive than silver. If the investor decides to trade their 6,400 ounces of silver back to gold at this ratio, they would receive 160 ounces of gold. So meaning that the number would double, right? So you went from having 80 ounces of gold that you traded for 6,400 ounces of gold when the ratio was 80-to-1. I mean, 6,400 ounces of silver when the ratio was 80-to-1. Then let's say the gap closes to 40-to-1. So silver comes up and it takes 40 ounces to buy an ounce of gold rather than 80 ounces to buy an ounce of gold. So then you trade that 64 ounces of silver for 160 ounces of gold versus the 80 that you originally had back when it was 80-to-1. It says by making this trade, the investor effectively increased their gold holdings from 80 ounces to 160 ounces by taking advantage of the favorable gold to silver ratio. So, I mean, it's a very important point. Silver is still very cheap, and you can obviously when that ratio begins to come down, you will be able to trade that silver in for more gold than you had before. So how gold bugs are losing their shirts. Inflation has been persistent risk for central bankers globally, and they are doing all they can to fight it. As a result, it appears the Fed is likely to continue to raise rates in the coming quarter. When that happens, there will be no respite for investors overweight in gold. The gold to silver ratio will tilt against them. So this is the gold to silver ratio tilting higher. So they're saying that silver is going to go higher. A closer look at the above long-term trend reveals a secret that many gold bulls might be overlooking, that the gold bull run might be over. All right, so they're saying that that it's around this price. Let's see. I'm trying to figure out what they're saying right here. It is showing that. Okay, so this is a 6-year ratio. So in 2018, it was 79 to 1. 2019, it was 90 to 1. That was wow. And then 2020, it dropped down to 72 to 1. And then 21 was 72 to 1. Then it popped up to 89 to 1 again. August of 22, and then now it's at 82. So yeah, it's saying that, and it just finishes off. It says that at 80 to 1 gold to silver ratio and persistently trending in that region, it's time gold investors realize that the smart money is rotating out of bullion, but where is it heading? The answer: while gold loses its luster, silver has taken on the mantra as the go-to precious metal for savvy investors. It's time to rotate out from gold and into silver. What do y'all think about this? I want to know your opinion. What do y'all think about this? Any opinions out there? I see we got 6 viewers watching right now. My girl's still asleep. Cool. Yes. So any opinions out there? Gold to silver ratio. Let's see. I'm going to go ahead and pull up the gold to silver ratio chart. Let's see. No, this ain't it. Where's my friend at? All right, let's see. Okay, yep, this is it. Yes, sir, this is it. No, yeah, it's it, but it's it, but it's not it. Let's see. Okay, yeah, this is it. All right, my bad, y'all. I had to make sure this was the right chart. Any opinions? Any opinions on this? So I'm gonna go ahead and share the historical chart here. Oh, my bad. Wrong button. I'd say buy both and do it every paycheck. Yeah, agreed. Agreed. I mean, it's all about balance, you know. I mean, I know people that are like, you know, super silver stackers. But you know, me, I gotta own some gold too, and then I gotta have both, you know. But I think that, you know, buying more silver during this time, silver's cheaper, so it makes more sense. I mean, it's almost like buying uranium stocks. Like uranium is the cheap stock, you know, so it makes more sense to buy them now. But however, I don't think I would go all in on silver at all. No, I wouldn't. It's too volatile. So yeah, here we go. Gold to silver ratio. All right, so this is back in. See how far this goes back. All right, so this chart isn't even. Hold on. Yeah, this chart doesn't go that far back. We'll probably find an older chart. However, so this is back to 94, 92. I don't know if Buffett bought silver in 92 or what. It was 90 to 1, 92 to 1 here. 98, there was a huge silver bull run, silver and gold bull run. So in 98, it went down to 42. So here it took you 92 ounces to buy, 92 ounces of silver to buy an ounce of gold. Here it takes you 44. So silver pretty much, you know, more than doubled during that time. So then you get over here, you know, 70, 79, it comes down again to about 53, 51. So, I mean, you could have, you know, traded some silver for gold then. I mean, it went from 80 to 51. I mean, that was a nice come up for silver. Then it comes down, it hovers down here, then it pops up again. Gold shoots up. I mean, every time this chart shoots up, that means gold is shooting up first. So gold shoots up, and then it goes above silver. So then it goes to 81. Then you have here in 2011, I think this is when silver hit the all-time high. It's like $50. It came down to 32 ounces of silver for an ounce of gold. Which, I mean, right now, I mean, I know I got 32 ounces. I would trade that for an ounce of gold right now. You know, I'm like, yeah, give me that. So yeah, for sure. And then it's been the ratio has been rising since then. And this is 2020, this is 2014. Let me go over here to new. Let's go over this way. There we go. That was 2014. We were looking at, went to 80, came down a little bit. This was in 2020. It went to 119. That's how. And silver was still down. I mean, at that point, I mean, that's like, I don't know if that's a record high or what, but I mean, that's wild. So gold shot up, hit the record high, and then it came down. So even if you bought up here, bought ounces of silver, when the silver caught up, you could trade 70 ounces of those silver. So, like, for example, let's say you bought 120 ounces of silver. You're like, okay, I'm gonna trade my ounce of gold for 100 ounces, 120 ounces of silver. So you make that trade, right? Okay, the price of silver skyrockets. Boom. Then you're trading almost 70 ounces, 72 ounces for, I mean, well, pretty much 71 ounces for an ounce of gold. And you still got 50 ounces of silver left. So it makes sense. Their argument makes sense for sure. Um, However, obviously that was crazy time. So it went up to 94 to 1 last year, and then now it's hovering about 80 to 84. So would you all buy more silver now? Looking at this chart, would you buy more silver now? Looking at this chart, I'm gonna find an older chart too. We gotta look. I gotta find the. I think this is it here. Sometimes I just be geeking out looking at this stuff. Sometimes I just like to look at this stuff. I looked at it on a different occasion. All right, so here's an older chart. I mean, like I said, the ratio was always closer throughout history, um, but it's been pretty high now. So let's see. This goes back to, look at this. This goes back to the 1900s. Look, it was 39 ounces of silver could buy you an ounce of gold. And that was considered high. The gold to silver ratio was high then. Then it goes down to freaking 18 ounces, close to the historic ratio. And then it just, like, let's see, I mean, then you obviously had the Great Depression. It goes up, blah blah blah, goes up again. At this point, I mean, silver was still down. Obviously, it was like illegal to own more than 5 ounces of gold. I don't think jewelry was excluded, and pre-33 coins were excluded as well. But here, gold went up, and so, like, I think they fixed the price of gold at this point, because they devalue. I think they revalue gold when they confiscated it. And silver was still plummeted. So it took you 99 ounces, and then it came all the way down to the 68, 22 ounces of silver would have bought you an ounce of gold. So if you were buying here, hey, I mean, obviously you had to hold for a long time. I mean, if say you had 100 ounces, you trade your gold for 100 ounces of silver, held it for 20 years or 27 years, gave it to your kids, whatever, they could have traded it for 16 ounces for an ounce of gold. So, I mean, it makes sense. The trade makes sense, to me. And here, it's crazy because, like, during this time, people were hoarding silver, and so the government was producing silver. They needed it for industry and such, and people started hoarding silver. And so, obviously, in 1964, that is when they started taking silver out of the coins, like over in this time period. So they removed silver from the coins. I think the Kennedys, I think it may have been 68 or something. I remember the John F. Kennedys, they went from what 90% to 30% or something. So then the gold to silver ratio goes up. 90, take your 90 ounces. And then, if you would have held it 2011, so it's like almost like every 20 years, this occurs. And so, yeah. And then you could have traded for 42. So obviously here, you get over to these like historic. I mean, this is like the 1700s. I have to zoom in on this one. But these are like the historic means of where silver, how many ounces of silver would take you to buy gold. I mean, 14 ounces, it stayed pretty close for a while. I mean, it started to get high here, 16, came down. I mean, it didn't start until what? Let's see, 1919, between 1919 and 1940, the end of World War I and the start of World War II. So, yeah, I mean, we had 2 world wars. I mean, here it was pretty high during these times. It's when Theodore Roosevelt and many others are in office. And yeah, and then it has these dates: 1968, the gold crisis. That was when I believe that's when countries started demanding gold back from Nixon and all of them. And that's when Nixon had us to do the. I think who was in office then? This was what's his name? Escaping my mind. I think he was Kennedy's vice president. What is his name? I keep forgetting. He signed the 1964 bill, Civil Rights Bill, with Martin Luther King. Somebody help me with his name. What's his name? Who signed the 1964 Civil Rights Act bill? It was John F. Kennedy's vice president at the time. Lyndon B. Johnson. That's who it was. Sorry, y'all. I had to make sure I had my history right. Yep. You got it, JT. Yep, JT knows. So yeah. So this was the gold crisis, it says. And let's see. It doesn't give no historical. I'm trying to see if it gives a historical point on it. But I'm assuming that was when the United States was running so many deficits that countries began to ask for their gold back, because that was leading up to when Nixon was in office and he had to sever the gold tie in 71. Because so many countries were like, hey, you're running deficits, you're spending more money than you have in gold. And then Nixon had to sever that tie. And then we did the deal with Saudi Arabia to get on the petrodollar system. So I believe that's the gold crisis they're referring to. 1980, obviously the inflation scare, and then interest rates peaked here. This was when interest rates were 20%. If you watch my interview with Frank Trotter, he said him and his wife bought the same house that he lives in, and they got it at 19% interest during this time. This is when Paul Volcker came into office as well. So then you get the Gulf War, gold to silver ratio goes up. I'm surprised they didn't put, I mean, this is a key date around this time here. I mean, this is the global financial crisis. I'm surprised they didn't put that on there as a key date. Because, yeah, that was a very scary time. The whole economic system almost collapsed. So, yeah. And then this is the Corona crisis. So, what do y'all think? Y'all think the ratio? What do y'all think the ratio is going to go? I mean, obviously it dipped here, but I think it got further to go. I mean, if you're looking at, obviously in the last 15 years, it was at 40 to 1. Currently, it's at 80 to 1. I mean, you're doubling your money on silver at that point. And then 22 to 1 in 1980. So, I mean, where do y'all think it'll go? Where do y'all think the ratio will go? Just like the Romans. Yep, exactly. Yep, the Romans debased their currency, spent a lot of money, started debasing their currency. They would chip little pieces off of the silver, like, just to kind of nickel and dime you. And then they started adding copper to their coins. And so just like how we did in 1964, like now many coins have copper instead of actual silver in there. I don't even think there's any silver ratio in there, right? Is there even any silver in these coins nowadays? Let's see. What are quarters made of? Let's see. United States Mint. That's not helpful. Okay, here we go. Yeah, here we go. Let's look at it. Look at our currency debase. Nickel and zinc. Yeah, thanks, JT. You answered that pretty quick. Let's look at our currency debased. We got fiat, flaky fiat currencies, and then we got this stuff. You got nickel. Look at the peanut butter is like it's supposed to be a peanut butter sandwich. The copper, and then you got the nickel again. Right. So yeah. I mean, hey, it's not real money anymore. I want to see what is a penny made out of. Pennies aren't even made out of copper anymore, right? They took the copper out of pennies, right? I think they did. Let's see. What are pennies made of? Let's see. Zinc coated with copper. Oh, dang. Only nickels are solid material that same 75%. Okay. So it's saying that I think it's saying that it's only coated with copper. So are pennies only coated with copper now? That's sad, yo. Debased currency. Debased currency. You get no real raw materials in there. I mean, I would argue that nickel is going to be definitely going to play a role in the future, but yeah. All right, y'all. My kids are up. Y'all have a blessed day. Appreciate y'all tuning in, chatting with me. I got to go get them. Yeah. Yeah. Thanks. I'm bullish. Appreciate you. All right, y'all. Y'all take care. Peace out.